Hi, it's Pete Birchler of StockMarketAlchemy.com. Today is August 26th, Monday after the close here in the U.S. markets, and wanted to just make a very quick post today covering a little bit of a non-confirmation that's happening between the indexes here. The specific non-confirmation I'm looking at is the fact that today the QQQ, so the Nasdaq 100, poked above this August 13th high. In fact, most of the indexes peaked on August 5th on this day here. So if we look at SPY, the S&P 500, and we can see that the second was actually the day the SPY peaked, and IWM was the 5th, August 5th. But then QQQ, we've seen it manage to poke above that August 5th high on August 13th, and then today it eclipsed the 13th high of the 13th by 1 penny, and then reversed and closed in the lower end of its range here today. So that is somewhat of a reversal candlestick, immediate selling on the push to new highs. Now, if you look at where the S&P and the Dow are currently, we can see look how far below the corresponding high the S&P 500 is here. A couple percent below. So significant non-confirmation. These indexes are much weaker. Same if you look at the Dow. Look at the Dow way off of its August 2nd high. So what is the meaning of that? Typically, for a healthy market, you tend to see indexes moving together, hitting new highs at the same time. So I think this is probably not a positive sign as far as the near-term prospects of the market. Interestingly, a lot of times the Nasdaq will hold up longer in rallies than some of the other indexes. In fact, if you go back to the 2007 bull market high, the Nasdaq was making highs into November of that year, whereas the other indexes peaked out in October, on October 11th. So again, not sure the significance of this here, but if you look at some of the past rallies, if we look at the Dow here, it had a couple areas where it made a similar type of non-confirmation if we look and compare it to what the Nasdaq is doing now. So if we go back to the high in September and October of last year, the broad markets peaked out on September 14th on this day, but the Dow came up and just slightly overshot that a couple weeks later on October 5th before really all of the indexes kind of fell together in earnest into the middle of November. So that was a case where the other indexes did not confirm the Dow. And a similar thing happened earlier in 2012, looking at the April and May peaks. So the S&P 500 peaked here on April 2nd and made a lower high, as did the Nasdaq on May 1st, whereas we saw the Dow poke above that high. So those are cases where at the end of a pattern, when you have some technical divergence, so you see that the new highs are not confirmed by new highs in the indicators, like we saw here. We have another, that's happening again here as far as the technical indicators. Here we have a momentum indicator on QQQ, peaked out on August 2nd, and despite new highs over the last 3 weeks or so, we see the indicator well below its high. So some indications of divergence happening here. One other fact to consider here is the sentiment backdrop, and if we click over and look at the put to call ratio, I'll show that here briefly. I've pointed this out in recent updates on the blog here, but there really hasn't been much significant in the way of put trading here. So this is a chart showing the put to call ratio. So the higher the ratio, the more fear there is in the market. So typically the higher the ratio, the closer you are to a bottom. And we can see that the most recent statistically extreme reading came here at this red circle, where it was outside the lower Bollinger Band or standard deviation band, and that is typically a topping type of signal. We've yet to see a close back outside the upper Bollinger Band, and the bands are very low here. Even in the uptrend since November of 2012, even on the minor multi-day corrections, we saw this ratio, which would be the pink line here, poke up significantly higher. It's trading at 5-day average of the total put call ratio right now is at 0.89. A lot of times we're looking at it up around 1.05. as far as the 5-day average goes, or higher at some of the more typical corrective type of bottoms. So just based on that, I think we have some room to fall here before this market sees enough fear and panic that it's able to manage a reversal. One other gauge I like to track is the VIX. So we'll look at the VIX here. And this has a couple sets of Bollinger Bands around it. This light gray set here is a standard 20-period Bollinger Band. And while that can be useful, a lot of times when you have a breakout move after the bands have squeezed close together like they did here in August, and then you have this initial breakout, that typically isn't the end of the move. On a very sharp, short correction it can be, but you may see things like happen back here where you have the VIX get low, kind of a band squeeze, initially breaks out, and then you follow it up with a little bit of pullback in the VIX, and then you see a further spike. And that's a relatively typical pattern that will happen here. So what I think we've seen here is we've seen a breakout in the VIX, seen some consolidation now, and we could see this VIX spike significantly higher, up into the 20 level or higher, based off some of these past corrective bottoms in the market. These other Bollinger Bands are some longer term Bollinger Bands where we might expect to see a larger correction. We might see the VIX to rise to those levels on even a relatively standard correction in the market, even if it's not a very large correction statistically. Typical correction in the markets is around 10%. So that is really what I wanted to cover for this update. If there are any questions, just leave a comment here under the blog, and I will update again. I have an update I want to go over in the bond market coming up here, going on over on what I think is happening there, both short and long term. That's all for tonight. Have a great day, and all the best to your trading.